Hello everyone, I am Siddhant. Today the chapter number 15 we are taking, the BFM, and it is a continuation of the previous chapters. And in the last chapter we have seen that what is treasury management, and this in this chapter we will deal that in treasury management what all products the government is taking is managing, the what all products we are understanding in this chapter. So in this chapter we are taking every corner of the topic, every important things, and if you are not reading books then it's also okay for this module C at least. And this chapter is all about the terms and we will deal with the terms. Now the chapter name is treasury products. So what all products the banks are dealing in? The banks generally deals in three broad products, like the forex products, another one is money market products, and the third one is the securities. The banks does not includes, and this does not includes the options and the equity products. The banks do not deal in the options and the equity products, but deals in the forex products, money market products, and the securities product. And in this product we will deal with the instruments or the tools in which they deals in and how they deals in. So first, in the forex products, the first term that comes is the spot. So what do you mean by spot? So we will deal with that. We will understand what is a spot. For example, you have given a request to convert your currency into a dollar. So whenever you have given a request and when it is converted in T plus 2 days, then it's called a spot. Okay. T plus 2 means the day when you requested plus 2 days. When this happens, it is called a spot. This is called a spot rate. And in the spot, there are two things, that is TOD and TOM. TOM stands for tomorrow. If you have given request and your money got converted in T plus 1 days, then it is called a TOM rate or T plus 1 rate. And if you have requested and immediately your request granted and you have given the exchange and settlement happens, then it is called a TOD, that is today rate, TOD rate. So I think you have understood this. Next we will see that, and one thing is very important, that the TOD rate and the TOM rate is find through the spot rate. For example, some spot rate is something given, then the TOD and the TOM rate can be found after discounting something from the spot rate. So this is, you should keep in mind. The next product of the forex product is the forward. Now what is forward? For example, you have imported some goods from outside. Now you have to pay the money, but the exporter says that pay me after 3 months. And today the dollar and the rupee exchange rate is equal to 75 rupees. But after 3 months, you are afraid that after 3 months it might become $1 is equal to rupees 80. So you will be in loss if you pay after 3 months. So what you will do, you will sign an agreement with the any third party, so that you signed it that after 3 months I will buy the dollar at the rate of 75. So if you make an agreement, that agreement is called the forward agreement. I hope you understand. Now the third products in this is swaps. What do you mean by swaps? Whenever we do the transaction of a spot and forward at the same time, then we call it as swaps. For example, you buy a currency at a spot and you have given that currency in forward. For example, today you buy a currency at a spot and you have given to another one, you have put into an agreement that after 3 months I will give you this much amount. So that is the forward rate. So at the same time, if you do the spot as well as the forward, that is called a swaps. And the next product in the forex products is the rediscounting. So what is rediscounting? For example, first we will understand what is discounting. Discounting of the bill. For example, you are a businessman and you are dealing with some other businessman and you bought something from the businessman, so you need to pay, but the another businessman is saying pay me after 3 months. So after 3 months he will receive the payment, but he received one bill in which this businessman signed. Now he will go to the bank with this bill and asking him that after 3 months the money will come to me, just take this bill and give me some amount. So the bank takes the bill and give the amount to the person. So this is called a discounting of the bill. Now in future, let this bank needs an urgent need of money. Now this bank will go to another bank and say that take this bill and give me some amount. Now this bank is taking the bill and giving some amount. This process is called rediscounting. I hope you understand the concept. And the next products of the treasury, under the treasury products, is the money market products. In this there are various tools like call money, notice money, term money, treasury bills, commercial papers, certificate of deposits, repo, bill discounting, CBLO, etc. And now we will see a short understanding of all these so that you can answer the question in the examinations. The concept I am teaching you is very important. At least 200 to 250 questions can be made only through the concept I am giving you. So listen very carefully. Now we will start with the call money. Whenever a money needed by one bank from the another bank for the overnight, then they can take the money through the call money option, and the rate decided as per the MIBOR. What is MIBOR? Mumbai Interbank Offered Rate. Next, notice money. It's for 1 day, more than 1 day, up to the 14 days. If any banks need money, they can take the money through the notice money. Next product is the term money. Through the term money, it's for more than 14 days up to 1 year. Then they can take money through the term money. Now next product is the treasury bills. It is issued by the government. The treasury bill can be T91, that is for the 91 days, T182 for the 182 days, and T364. There are 3 types of treasury bills. These can be traded only electronically. If you visit RBI website, there is a e-Kuber site, and under that e-Kuber site the banks trade these treasury bills among themselves. And these treasury bills are maintained in the SGL account. This SGL account is maintained in the RBI, and this SGL stands for Subsidiary General Ledger. Next, this is the commercial paper. It is issued by the companies. It is for 7 days to 1 year. The minimum amount is 5 lakh of rupees, and it's the commercial paper can be issued by only those company who having a credit rating of A3 and above. And next product is the certificate of deposit. It is issued by the banks to raise money, and it is for the high net worth individuals, for the NRIs also, and it's the interest rate is higher than the actual deposit rate the bank is offering, and it is for the 7 days to 1 year. The minimum amount for the certificate of deposit is 1 lakh and in multiple of that, and it is also tradable. And one thing I missed in the commercial paper, that is minimum amount for the commercial paper is 5 lakh. Next product is the repo. Under the repo, if the banks need money from the RBI, they can take money with the help of repo. Next is bill rediscounting. I already discussed what do you mean by rediscounting. That the same process happens in this. If the bill discounting is the transaction between the one bank into the from one bank to another bank, and they give the bill discounted. They give the bills, that is the discounted bills, to one bank and take the money from that. And this bill rediscounting is at least is between 3 to 6 months. The bill to pay the amount from the another businessman is between 3 to 6 months. You should remember. Next is CBLO. collateralized borrowing lending obligation. This CBLO is the product offered by the CCIL, that is Clearing Corporation of India Limited, and it's for those who can't access call money market. As we know that call money market is for the bankers, and there are also various companies which needs money overnight, so they can reach to the CCIL and can take money through the CBLO. In this, they have to give something for taking the money, some securities for taking the money, and it is the government securities that they need to keep while taking the money from the CCIL. I hope you understand this. Now the next category of the product is the securities. Under securities, the securities market product is generally of greater than 1 year, then it is a securities market product. And the examples are government securities, corporate debt paper, debentures and the bonds, convertible bonds, equities. So we will see what's the difference between the debentures and the bonds. The debentures are issued by the companies and the bonds are issued by the government, and convertible bonds are the bonds which converts into equities. So what is equities? For example, you have taken ownership in the Reliance, then it is a equities, and if you giving loan to the Reliance, then that is called a debt. So that's the difference between the bonds and the equities. Bonds is just a debt and equities is the share ownership in the company. That's it with the concept. Now we will see the questions. Question 1. Banks have gained wider access to the foreign currency funds. Now we know that the banks maintain foreign currency in their premises. So where they get the foreign currency? Now we will see the option. Deposit maintained by the NRI. Yes, NRI has, there are lots of accounts that NRI maintains in India in a dollar form. So that is nothing but contributing our foreign currency. Next, cash balances in the EEFC account. What is EEFC account? It is exporters earner foreign currency account. If someone exports, they earn in foreign currency, so they keep that foreign currency into that EEFC account. So that is a cash balances in the EEFC account. This also included. Next, float funds from the ECB. What is ECB? ECB stands for external commercial borrowing. So whatever the funds that comes in the form of loan, that is also counted in the foreign currency funds. So the option is D. Next question, which of the following options is not used to hedge currency? Now, what is hedging a currency? Hedging of currency means to protect the currency. For example, you imported something from let's say Afghanistan. So you need to pay the amount after 3 months in dollar. So now the dollar rate is $1 is equal to 75 rupees. But after 3 months, it might go $1 is equal to 80 rupees. So after 3 months, if you buy $1 at 80 rupees, you will be in loss. So what you do, you at this time, at present, go into a forward contract, and in this contract, you sign that after 3 months, I will buy the dollar at the rate of 75. So this agreement is doing nothing but protecting the currency. That is called the hedging of the currency. So what all are the options to hedge the currency? The options A is securitization. It is asking which of the following is not an option. So securitization, what is securitization? For example, you have given a loan, and against that loan, you have taken the home as a security. So that process of keeping your loan safe, that is a securitization. So this securitization is not protecting the currency. It is for the securitization of the loans. So this option is the right answer. What all other options are? In the forward contract, we used to hedge currency. So this is true option to hedge currency. Options which is not used by the banks. The banks never uses equities and the options as a product. Otherwise the bank uses all as a treasury products. Now forward options also used to hedge currency, and swaps is also used to hedge currency. Next question, what is open position? In the last videos or last to last videos, I already have discussed what do you mean by open position. Whenever there is the purchase and the transaction and the settlement does not happen completely, that itself called a open position. So in this parlance, in the banks equities or the securities bonds parlance, what do you mean by open position? any residual position of a bank at the end of the day is overbought, and any residual position of the bank at the end of the day is oversold. What it is trying to say, for example, you bought something and you sold something. If the buying and selling is out and out equal, then it is called a closed position because you are not at any risk. But if something you have bought and you are selling nothing, then it will be very difficult. For example, your bank, some customers come to exchange dollar into a Indian rupee. So if there will be a lots of dollar in your branch, then it will be a problem because you are short of the Indian currency and you have more of dollars in your banks. So that will create a problem. So that is called an open position. So in this question, option D, that is both. Next question, for what purpose the company buys a forward rate agreement? Whenever there is a forward agreement happens, it basically to reduce cost and to reduce the risk. So both A and B option is right. Next question, securities market divided into. Any securities market is divided into the primary and the secondary market. So what is primary? For example, any product is coming into the market. So first it will come through the primary market. Now in India, who acts as a primary market? SBI or RBI. They introduce products to different institutions or individual. Now when they buy the first time products from the SBI or RBI, that is the primary, that is called the primary market. Now these individuals now wants to sell to another person. Now where they will go? They will go to the secondary market. In secondary market, they will go and sell it to the another person. So that is the difference between the primary and the secondary. So in this question, the option is D. Settlement refers to. Option A is sale and purchase of the foreign currency. Yes. Settlement means to complete the transaction. That's it. Sale and the purchase of the foreign currency is settlement. It's an example of the settlement. Yes. Lending and borrowing. Yes, this is also an example of settlement. Sale and purchase of the securities. Yes, this is also an example of the settlement. So the option is D. Next question, forward exchange rates are arrived at. Forward exchange rates, how the forward exchange rates are arrived at. We don't need to enter much into this. We just understand some concepts. For example, every rate is decided through the spot rate. So spot rate is the reference point. Let's say it is 80. I'm just giving you an example to let you understand the concept. Now it is saying 3 month forward, it is +4, and 6 month forward, it is -3. And these numbers came through various formulas which they are known of. We don't know even. We just know that these concepts. We don't know the formula and we don't need to understand the formulas. They just come with the numbers. That 3 month forward, this rate will come, and 6 month forward, this rate will come. So whenever there is a plus, that is called a premium. So in the 3 months forward, the spot rate will be in premium, and after the 6 month forward, if it is minus, it is called discount. So whenever we need to find what will be the rate after 3 months, so you need to add it. So it will be 84 in 3 month forward, and after 6 month forward, what will the rate? It is 77. So I'm just giving you an example to let you understand the concept. So it is asking question, forward exchange rates are arrived at. Option A, on the basis of the interest rate differential of the two currencies. So it is a part of that formula which we don't need to study. You just need to keep this into your mind so that you can answer the question. So treat it as a factual data, and just you need to remember this. Option B, differential to be added to the spot exchange rate. When it is to be added? When it is in premium. So this is also true. Differential to be deducted from the spot exchange rate. When it will be done? Deducted when it is at discount. These things we have discussed just now. So answer is D, all of the above. Forward exchange rates are decided by all this. Next question, which of the following statement is not correct? Option A, balances held in the nostro account earn interest. No, it is not. Nostro account is a, what is? It is a current account. So we will see what is nostro. whenever nostro and the vostro. Vostro means your account with us, and nostro means our account with you. It means that our account is in another foreign currency bank, another foreign banks. Let's say our account in New York, then it's called a nostro account. How can you remember this? This vostro is just like a Y. So this vostro, remember it as a your first, your account with us. You can remember like this. And this nostro account is a current account, so it will not earn any interest in that. We have taken lots of questions today, and also the concepts. Both, if you understand it completely, you will definitely get to know 200 to 250 questions. That would be enough. You know, you don't need to read the book. You just need to complete it. Option, next question, rediscounted of the foreign bills. As we discussed that when this rediscounting happens, it's an interbank transaction or interbank advance. This rediscounting of the bills happens. Next question, in banking, interbank operations are not allowed. So in the banking, which interbank operations are not allowed? Equities and the options, we have discussed that it is not allowed. Each issue of the 91 days treasury bill is for, it's minimum 500 crore. Each issue of the 91 days treasury bill is for the 500 crore, and treasury bill of the 364 days is of 1000 crore. These are factual data you need to remember. Auction of the 91 days treasury bills conducted on weekly basis. Every week the 91 days treasury bills will come, used to come, and treasury bill 364 is for fortnight. Treasury bills opened for, it is opened for everyone. Corporate, HNI means high net worth individuals. See, NRI, it is open for all. Commercial paper issued at the face value of, it is 100. It's a factual data you need to remember that CP issued at the rate face value of 100 rupees. Why banks tend to invest in the commercial papers? So why commercial papers is very good? Because credit risk is relatively low and limited to short period. As we know that commercial paper is for less than 1 year. So credit risk is relatively low as compared to the other products and limited to the short period. That's true. Option B, yield is higher than interbank money market yield. Yes, whatever the interbank money market is giving, it is giving more yield than the interbank money market. As we know that if you go in the market, whatever the company is giving is every time more than whatever the government is giving. The rate I'm talking about. Option C, it being a tradable instrument, there is no liquidity risk. So this one is also true, as it's a tradable, so you can trade it at any point of time and get the cash through while selling this instrument. So here the option is D, all of the above. Next question, terms related to the repo is. Terms related to the repo is haircut. So what do you mean by haircut? For example, you have given a loan of 50 crore of rupees to some companies. Now that company is ready to repay 35 crore of rupees, and the bank agreed to take this amount and let off 15 crore of rupees. So this 15 crore of rupees is nothing but a haircut given by the bank. Next question, government securities are issued by. It is issued by RBI. RBI issues the government securities, and the government securities varies from 1 year to 30 years. If the government wants to issue an instrument for less than 1 year, what they will issue? We have discussed, that is treasury bills. And treasury bills for the 91 days, 182 days, 364 days. And if the government wants to issue for less than 91 days, they will issue cash management bills. You need to remember all these things. These are very important things. Now, next question. Cash management bills have maturity of, we have discussed, it is less than 91 days. Basis point value is associated with. You know that 100 basis point is equal to 1%. So it measures the risk measurement. This basis point concept used in the risk measurement process. Next question, corporate debt paper includes. It includes medium term and the long term, because this corporate debt paper meant for the long term money instrument. For the short term, what the company issues, it issues commercial papers, certificate of deposit, etc. Debentures are governed by, it is governed by companies law. When the government issue government issues bond and the company issues debentures. So it is governed by the company law. That's it. Thank you. Please subscribe the channel.